Well, good morning, everybody, and a warm welcome to you to BDO on this cold and windy January morning, where we are feeling the after effects of both Hurricane Christoph and the Trump presidency, and of course, the ongoing challenges of a global health crisis. Welcome to our Business Restructuring Outlook 2021 webinar, at which we focus on consumer markets, perhaps the sector most impacted by these global challenges. I'm Stuart Deacon, a partner here at BDO, leading our special situations M&A business, and I'm focused on business rescue. We have three excellent speakers lined up to speak with you this morning. Each will speak for around 10 to 15 minutes, and if you have questions, I encourage you to use the chat function so that we can draw these together for 10 minutes of conversation afterwards. I'll also be supported by my colleague Neil.stockham in relation to any questions you might have around Brexit. Of course, if there's anything you want to discuss with any of the presenters or myself, we'll make sure that you have our contact details for a follow-up. So without further ado, today you will hear first from Sophie.Michael. Let's go to the next slide. BDO's head of retail and wholesale, to talk about this sector that she is deeply passionate about and from where she draws many of her audit clients. We'll then hear from Harry.stoakes, our M&A leisure sector expert and partner, who will provide us with his economic outlook for this year. And finally, Sarah.Rayment, a fellow business restructuring partner with a special focus on real estate, will talk to us about the restructuring outlook for 2021 with that special consumer markets focus. So without further ado, let me hand over to Sophie, and I'll speak to you all again later.
Good morning all, and thank you, Stuart. For those that might attend my retail trading update, which will take place later this month, will know me. What I'm going to be covering here in the next 15 minutes or so is just really a brief summary from some of the content of that trading update. So I hope to see you all at the more lengthier version later this month. Every year I start sort of reflecting on how technology has disrupted retail. And this year, it's very much focused on the pandemic. And the pandemic has just done that, but disrupted retail to a much deeper extent. In fact, this year, I'd say that technology has been the enabler, and it's the enabler allowing retailers to continue to trade and shoppers to continue to shop. It's also increased the pace of that change. And on the back of this, we've seen many negative headlines about the death of the physical store. But if we really stand back from it and look at it, this is a situation where stores have been forced to close as a result of the pandemic and government order. And therefore, you can't really take the behaviours of the consumers under such conditions and say that is going to be what shapes the new normal. Of course, the speed of change has become faster, but actually what the pandemic has done, instead of dividing physical and online, in my view, it's brought them together. It's really shown how these two channels have to work seamlessly together. And ultimately, that's the way the consumer sees the marketplace. And in fact, if we look at some of the retailers which have outperformed, it's those that have used both online and their stores where open to really leverage and drive sales. And this is, once again, that will be the winning themes. Next slide, please. So the pandemic has changed our way of life in the UK and globally. And total retail sales in 2020 saw a drop of 3.6%. That's the biggest decline that we've seen in 50 years. So it just shows you the enormity of the impact. But it's also impacted stores once again far more than any other channel. If we look at consumer confidence, we know that consumer confidence drives discretionary spend, and consumer confidence fell when we voted to leave the EU in 2016. But it took an absolute battering in April when stores closed. It slowly climbed up as all the government schemes came into play and there was some control over the pandemic, but it has remained very low. And it's going to be very difficult to see how there's going to be a notable increase in that consumer confidence. And as we know, consumer confidence drives the discretionary spend. Our high street sales tracker, for those that are familiar with this, our high street sales tracker looks at like-for-like sales on a weekly basis. And this particular one focuses, this graph focuses on total like-for-likes across the past 2 years, but also the in-store like-for-likes. Now, what you can see here is that absolutely in April, as we would have expected, in the first lockdown, there were far more stores that have closed compared to these current lockdowns. But that in-store discretionary spend approaching, therefore, negative 100%. But what's interesting is that total spend, almost a third of consumer spending was wiped out in terms of discretionary spend in April. And that would have cost retailers dearly, taking out a third of discretionary spend. But it also meant that retailers were deferring orders, and therefore that there's an impact on other businesses along that supply chain. Once again, though, the physical store took the heaviest impact. It slowly picked up and there was some good spend over the summer months. But as we'll see, it was in particular areas of retail. And as we entered November was negative 3.2%, despite the heavy discounting. And we'll come back to looking at December in a little bit more detail. The next slide on the high street sales tracker, we track discretionary spend by lifestyle, fashion and homeware. And unsurprisingly, this also shows the non-store tracker. Unsurprisingly, that really shot up in the months of closure. We normally see that at 10 to 20% growth, but at times it was over 100%, and it has remained high as shoppers have been reluctant to go back into physical shops. What's really interesting, though, I feel, is the older shopper. The older shopper who may have previously found online shopping unappealing, shifting to online. And last year at the retail trading updates, we spoke about the strength of the grey pound and are retailers targeting on this available purse? Now, are they targeting it in the right way? There will be some reversal, as we know, to shopping in store, but some of these behaviours will stick as this older customer has now become accustomed and understands the convenience of that, has appreciated the convenience of that online shopping. Recent research found that almost 4 out of 10 over 65-year-olds said that they will be buying more online post the pandemic. When we look at this in a little bit more by category, in terms of the explosion of online spend, next slide, please. You can see that grocery really led the way. As lockdown began, grocers saw available slots quickly fill up, and many of them had to, in fact, close their portals. Tesco's, as we know, increased delivery slots by almost threefold. DIY and gardening, Wix and B&Q are among those that have reported big increases. And previously, this was very much store-based. Fashion, even though online sales were much slower than other sectors, online sales have been far more resilient than store sales. What's really clear from this is the importance of the investment in this online channel. And those retailers that have focused in recent years on building this channel have performed better. And if we look at some of the retail failures, it is really those retailers that were struggling before the pandemic also that found it incredibly difficult to absorb the shock that this pandemic had to their model. Turning to the next slide, Christmas trading. Black Friday has seen Christmas shopping starting earlier and earlier each year, and this was once more the case. But also this year, perhaps the shoppers were thinking about being more organised and giving themselves more time with the pressure on volumes of deliveries. In fact, the online channel has placed huge pressure on the online delivery infrastructure, and we saw many of the delivery firms recruiting thousands more people. One positive for retailers is that consumers were spending more time at home, and this allowed them to be far more flexible about receiving deliveries. Indeed, we know that Christmas for 2020 was all about the home. It was shopping from home, delivery to homes, eating at home, and spending more on homes as people look to have spent most of their times within their homes. The next slide on our BDO High Street Sales Tracker shows the like-for-likes, and really it's focusing on this golden quarter, but also week for week beyond that. And what's really interesting in this is that it was a really, really mixed bag. So the figures for October, November have been well trailed. But when you got into December, what we saw was that when you look at that total figure of like-for-like, the first couple of weeks of December were positive. But what happened in week 3 with the lockdowns, which is that Super Saturday, historically, where you had all the late shoppers, it fell to negative 11%. And that's total spend for retailers, not just in store. Week 4 was negative 23%, so almost a quarter of total spend on discretionary spend taken out of Christmas trading. And one may have thought that actually the shopper was waiting for the January sales. But actually, when you can see those weekly figures week by week in terms of January, it's gone into negative double digits. In reality, the shopper isn't spending. And when they see that they're at home at least until a minimum of January through to half term, it's unlikely that they're going to be spending on that Christmas, on that winter stock. Just quickly in terms of the shape of the recovery, the next slide, please. As it stands, the first 4 months of 2021 is set to be every bit as difficult as 2020, with non-essential shops forced to close. It does seem that the vaccine and the pandemic, it's going to continue to play a strong role in 2021 and possibly even restrictions next winter. But there is hope that in the best case scenario, we would see these restrictions begin to ease by spring and early summer. And hopefully people able more freely to shop and socialise. What else is quite important is that as the stamp duty holiday comes to an end and the government schemes, the furlough scheme in particular, towards the end of April comes to an end, we will see also some difficult months in that second quarter with potentially an increase in redundancy and pressure on the housing market. Thirdly, another factor is Brexit. And although having a deal has lessened the potential, it's businesses having to adjust to the new way of trading. Breaking this down in a little bit more by category, the next slide. While at first glance, some of these, can I have the next slide, please? While at first glance, some of these growth rates look very promising, we've got to remember they're coming off a very weak base. Just looking at a couple of these, if you take clothing and footwear, 2021 is still forecast to be 2.5 billion less spent than in 2019. And aside from 2020, the lowest it's been since 2014. Next slide, please. DIY and gardening, after a huge drop in sales in April, actually it enjoyed a strong 2020 as shoppers turned to redecorating their homes and spending more on their gardens. So hence why there's only a small further increase in 2021. Electricals, quite a mixed bag. In 2020, people buying in terms of food stockpiling and fridge and freezers and home office, but other electrical items such as mobile phones, etc., with delayed launches and people unlikely to have those big spends, struggled. Food and grocery grew by 10.1% in 2020, and that's the highest it's been for 40 years. Now, it's expected to fall, therefore, in 2021, as hopefully the economy opens up and people start returning to restaurants and pubs, etc. Next slide, please. So, whilst the pandemic has resulted in a number of retail casualties, particularly those that were based in locations where footfall has plummeted or their product has become more redundant, in contrast, there have been some who have performed strongly or at least substantially outperformed the market. And it's not just those with a pure online presence, but as I say, although those have certainly defined some of them, it is those that have invested historically in that online channel and have been able to really use all of their channels seamlessly together. I don't have time to run through all of these, but it's looking at those and the actions they've taken. And this list is a list of actions that we believe are absolutely fundamental to all retailers in 2021. Just a couple of the ones which I think are absolutely key. React rapidly for relevance. Retailers, online pure plays, they've really demonstrated how rapidly adapting everything from product mixes to marketing messages make a difference, and remaining relevant and having the right messages to your customers, absolutely key. And the second one, whilst cash preservation is key, investing in and capitalizing on new technology can cut costs and improve sales. And despite the fact, as I say, the challenge on resources, and it's going to be harder than ever to invest, this is going to remain absolutely key to remain competitive. So finally, every year we reflect on the past year and we can't quite grasp the speed of change. My own view is that, as that shape of recovery shows, it'd be a tough next 6 months. But as we come out of this, people are going to continue to shop, and those businesses, those retailers that do trade through this storm, I'm confident they're going to find really good opportunities as consumers revert to some of their previous shopping habits. Some of the behaviours that we've seen will stick, but there'll also be a return, and it's trying to find that balance in the new norm. Thank you.
Thanks so much, Sophie. So I am Harry Stokes. I'm a leisure sector M&A partner, and as a lot of my sector has been closed over the last 9 months, Stuart thought I'd be well placed to give an economic update. Next slide, please. So let's start with a retrospective. This is ONS data, quarter on quarter GDP growth. This chart will be no surprise to many of you. So what we saw in Q2 2020 was a 20% contraction in the economy, the largest for 300 years since the Great Frost of 1709. I had never heard of that, but we've all heard of it many times over the past 9 months or so. So this data goes to September. In November, the ONS data was a further contraction of 2.6%. And in December, there would have been a further decline as well. So what's happened to unemployment? Well, it's still significantly below where it's got to in other recessions in the 70s, 80s, and the GFC of 08-09. If we could just flip to the next slide, please. This shows the impact of lockdown 2 and 3, where the economist last week thought it might look And so we all talked about the shape of this this contraction, whether it be an L shape or a bathtub or a Nike swoosh. This looks like a chipped tooth to me, but you can see the impact of lockdown 2 and 3 is milder than before because the economy was already starting from a much lower base. And as Sophie alluded to, there's more things open this time than last time. Next slide, please. So yeah, this is unemployment. Previous recessions, it went way over 8% in the 70s and 80s, touched about 8% in the GFC of 08-09. Rishi Sunak saying it will get to 7.5% some point this year, probably late Q2. In summary, unemployment right now is just shy of about 5%, so we haven't really seen the impact yet on the labour market. Next slide, please. The global picture. So how have we compared economically against other large economies across the world? The grim reality is not great. In Europe, we lag behind Spain for the prize for the biggest contraction last year. Spain is obviously an economy that relies very much more heavily on tourism than the UK. This data is from Capital Economics, and what they're saying this year, 21, 7.5% growth. So a steady recovery. What happens next largely depends on the vaccine rollout. This is a chart I took from the Telegraph, and that green line looks like the government target of 2 million a week. And I checked the data yesterday. The last 7 days, we vaccinated 1.8 million people. So it looks like we should be on track for that crucial 2 million a week. 4.3 million have received the first dose to date. So by the end of March, the priority list of 25 million should have been vaccinated. And by the end of May, that kind of middle dotted line in that number 2 diamond of herd immunity should have been achieved at the end of May. So it ties up with what Sophie was talking about, second half of this year, starting to see a return to normal trading patterns, normal behaviours, and out of restrictions. Next slide, please. So pretty grim so far, but where are the positives? So assets, asset prices have maintained very high. We can see this. This is house prices. See the last recession, massive contraction, towards 20% drop in year-on-year house prices. This time, we've got that really strange dynamic of the biggest contraction in the economy since 1709, yet house prices went up 6%. Next slide, we take a look at the equity markets. And across the world, equities have performed very, very well in 2020. Although the FTSE 100 now at about 6,700 and was in the mid 7,000s before the crisis, it's still got about 10% to go. But on vaccine news in November and December, it did shoot up about 10%. So it's this strange dynamic right now between an economy on life support really, but assets performing very well, and that's largely due to the big stimulus packages that our government and many governments across the world have put in place. And what about the consumer? Well, the positive is this is the data to the end of November from the ONS shows that consumers in Q2 and Q3 of 2020 saved a lot of cash. So this is the household saving ratio, which is the percentage of disposable income that is saved. And what the ONS is saying is for better off households, we're saving up to £350 per month, but obviously it's quite polarizing because unfortunately for some households who are worse off, that wasn't the case, and that they were losing £170 per month. But the net of all of that is 100 billion saved to the end of November, and that's probably more like about 120 billion now. And if you think the UK economy is just over 2 trillion, so that's roughly 5% of the UK economy currently sat in bank accounts ready to be spent. So I'm looking forward to the spending boom when it happens. The other good news, of course, is debt is incredibly cheap. Government borrowing is very high, but it's been way higher in the past, which we can see in that chart in the left, which goes back to the start of the previous century. And the funding of the 2 world wars saw government borrowing going over 200% of GDP. So we're not quite as bad as we have been before in terms of the public sector finances. And of course, borrowing is incredibly cheap at the moment. So if there was a time for the government to borrow, now is the time. And the next slide, we show what the cost of debt, government bond yields are at the moment, less than 1% to borrow over 30 years, which is quite incredible. So we've got that strange combination of high borrowing, low inflation, and low cost of borrowing. In addition, private credit funds who are supporting M&A activity have $300 billion of unlent money, effectively. And of course, many people in my profession talk about the 2.5 trillion of unspent or uninvested private equity dry powder. So there's huge amounts of liquidity out there, and money is very cheap at the moment. So that's a positive view. What about some potential downsides? And Sophie touched on this. The government has essentially thankfully kept the economy afloat and has protected consumers, as we've seen in those unemployment statistics, labour market, and business. And at the end of October, there were 2.4 million people on furlough. That number is likely to be higher now as we've gone into lockdown 2 and 3. But at some point, these support measures will come to an end, and unemployment will sadly rise. But my sense is Mr. Sunak has started on this journey of protecting consumers and business, and he will not look to end the support before the economy is ready for it. So I think it should be okay. Next slide shows consumer confidence. However, that classic indicator, car purchases, big ticket item, down 30% in 2020 on 2019. And the consumer confidence GfK data there on the right shows a similar picture to what Sophie was showing. It's pretty low at the moment. And of course, we've got our old friend Brexit. Many of us have forgotten about that, although our colleagues in VAT haven't, because that seems to be like a real complication at the moment for importers and exporters. This chart is, again, something I've taken from The Economist last week, which shows productivity in Britain, Denmark and Ireland when compared to the original EU countries. And we're on a steady decline. Then we all join the EU, and then look, our productivity shoots back up. And now, whilst there is a trade agreement in place, no doubt there will be friction to trade in goods and services. And the OBR, that optimistic bunch, are saying there's going to be a 4% hit to GDP in 10 years' time from the current Brexit deal. So that's obviously another headwind for us all to deal with. But I think the biggest risk to the economy this year is uncertainty and fear, as we move from a health crisis to an economic crisis during the course of the year. will take more confidence across society for people to get out there and spend money. So what's going to happen? This slide takes data from the OBR, and they did the chart on the left. The purple line shows where they thought things would play out in March last year when we were in the depths of the crisis, and then again they did an update in November, which is that blue line, and the chart on the right shows where the economy might land over the next 5 years with different vaccine scenarios. So upside case, vaccine widely available in spring 21, central case by mid 21, and downside case, no vaccine being rolled out fully during the course of 21. So this is why it's so important to accelerate the rollout of the vaccine, because if it is all done in spring, for example, then we shoot back up on that dotted line in that upside case towards the yellow line straight away. If it's a summer rollout, we stay in that middle blue line, in the middle of that light blue shaded bit on that left chart. So the way we're run rating at the moment, with about 1.8 million in the last week, if that can be accelerated, then the speed of the recovery is going to be so much quicker. At the moment, it looks like it will be it'll take 2 years to get back to December 2019 GDP. But if we can hit that upside scenario where vaccine rollouts is quicker, then it will only take this year, the rest of this year, to get back to GDP levels at December 2019. And what's keeping the economy afloat at the moment? Well, it's government borrowing, government supports, and the government will borrow over 400 billion this fiscal year, which is roughly 20% of UK GDP. And is that something we should be worried about, being so high? Well, my take on this is it's not a problem, because the cost of borrowing is so low, the maturity on that debt is so long into the future. And the important point is this bar chart on the right, which shows that everyone's doing it. And if everyone's doing it, the UK is not going to be isolated as a basket case where sterling takes a massive hit and we're all in trouble. If everyone's borrowing, then we're just part of the club, and it's a much better position to be in. So as long as the government keeps supporting consumers and business, then the economic consequences of the crisis that we've been through will be much easier on us all. But of course, at some point, taxes may have to go up. But I think what we've seen is that this time the government are not going to embark on a path of severe austerity like they would have done or did do 11, 12 years ago. And this time they're going to want to see the economy on a much surer footing before they start thinking about tax raises. But of course, we'll see in March what happens. Thank you very much. Over to you, Sarah.
Thank you, Harry. I am comforted by your comment that the UK isn't a basket case, because sometimes when I watch the news, I'm convinced we are a total basket case. Good morning, everybody. Thank you for joining us. Normally, following Christmas trade, retailers will have built up a war chest to see themselves through the dark months of January and February, or they will have been topping up their cash reserves by selling stock. But this year, as we've heard from Harry and from Sophie, has been extraordinary. And many businesses are completely depleted of cash, with months to go before they'll be able to reopen. And as we've heard from Harry, we're not quite sure when they will be able to reopen. Management need, though, to be thinking now as to when they're going to reopen and trade and what they're going to do with those balance sheets. They need plans for both trading and for the balance sheet. So what I'm going to look at today is quickly just some of the issues lurking on those balance sheets, and some of the practical or some of the considerations that businesses and management and advisors should be looking at for these consumer market type businesses. What I'm not going to do, and you're all going to breathe a sigh of relief, is going to take you through the restructuring options, the SIGAs, restructuring plans, moratoriums, CBAs, because I know that you all are all really familiar with those. Obviously, consensual process is a far more favourable option, avoiding a formal insolvency process if at all possible. And we think that a lot of businesses will restructure consensually, but if they can't restructure without a formal process, be that because of the funding ask is too much or deals can't be reached with stakeholders, then CBAs and pre-packs and restructuring plans with possibly a CBA attached may well be the option. So if we move to slide 2, the impact on the balance sheet, and we have listed here a number of the items or categories of liabilities that will have built up on the balance sheet. So businesses that have closed, they've seen an unprecedented build-up of these liabilities: HMRC debt, rent deferrals, stretched creditor loans, and CBILS and the such like. The big question, which is taxing all of us, and I'm sure all of you in the audience, is how we're going to restructure those debts. I don't have the answer for you today, I'm sorry. It's our view that lenders will have to work with government to agree how we restructure and what happens with the debt which has been guaranteed by government. Government won't want to see businesses fail, lenders don't want to see businesses fail, so that at some point it will become clearer as to how this government-backed debt will be dealt with, and whether the debt will be converted into grants. The more money the government puts into the system, the harder it's going to be for it to be restructured without some form of government support. So then that takes me to the build-up of property costs. I will cover negotiations with landlords in a bit more detail in a moment. So landlords will have received little or no rent and possibly service charge for over a year. And the approach to dealing with landlords needs to change from where we were previously. We need to treat them as a stakeholder. We need to be more consultative and open to help both the tenant and the landlord get back to some sort of normalised trading, whatever normalised trading might be. We then have debts due to HMRC, primarily deferred VAT, but also there may have been a lag on some prior HMRC debt. This, of course, is now subject to the Crown's secondary preferential status in any formal insolvency process, which adds another complication, because this may cause lenders to take a more cautious approach if they're being asked to extend facilities or waive covenants in order to help the businesses open back up. So what is clear to us is that stakeholders need to understand all the options available in order to make informed decisions as to what is the most optimum route to go down. Each case is likely to be different depending on the access to cash that was taken into, or the cash that was taken into the third lockdown, their access to liquidity now, the strength of the management team, and also product offering. Just a comment on management. The businesses that we are seeing now are much stronger. They have much stronger management teams than those we would have seen maybe 18 months ago. And that's simply because the businesses that they were operating pre-COVID were trading successfully. And albeit in the case of retail, that they may have been undergoing a structural change due to digital transformation, as Sophie touched on earlier, the management teams are much stronger, and they do understand their businesses, which in some cases does make it so much easier when you're discussing the options with them. But one point, management do need to be motivated to restructure consensually, Rather, that it can be quite simple. If they have no skin in the game, as it were, if they have no equity, they could simply opt for the easy option of a pre-pack admin and a sale. So there may need to be an element of carrot and stick, incentives to pay back debt, that being either property, lending, or debt to HMRC. It may seem to some management teams that it's easier to simply cut and run for the pre-pack. And it'll be interesting to see how it evolves in terms of management incentives, to how that evolves to try and get consensual deals. So the key message from this slide, really, I don't have the answers, obviously, is early engagement and understanding the restructuring options. So if we move to the next slide, thank you. So these are some of the areas which are common across all consumer markets, the issues and considerations that the businesses will need to be looking at as they come out of lockdown. I will just pick on 3 of them: landlords, pre-COVID business models, and phased reopening. So landlords, I've been involved in loads of presentations over the last 9 months and negotiations with landlords, and I think what we've realised is, or what's clear, is to be open. Landlords are key stakeholders in the businesses we're discussing today, and as I mentioned earlier, many of them will have received little or no rent for a year, and they have their own issues with stakeholders, their own lenders and their shareholders. Previously, there was a reluctance to share MI on a unit by unit basis, but if deals are to be reached, this does need to be overcome. And this was an approach which was successfully used by us in the recent case of Deltic, which is or was the UK's largest nightclub operator, so clearly wasn't operating for many months. In this case, our strategy was early and consistent engagement with landlords, informing them of the options that were being pursued and providing regular updates on the sales process, including the preferred preferred bidder status. We worked alongside an experienced agent that assisted us in the negotiations throughout the process. We engaged with the landlords, we considered their each individual position, and we ensured that they were part of shaping the outcome, and they weren't just told of the outcome after the event, so they were taken along with the process. It's clear in this particular experience that landlords were supportive, but they don't expect to provide long rent-free periods. They require the flexibility to return to normal terms once trading recommences. And in that type of business, you could see why that would be the case. The nightclub operator hasn't been operating for many months. And therefore, when we're all allowed to go back out and party, you would expect operations and trade to return quite quickly. So it makes sense that the landlords would be looking for some sort of upside. And they are looking to find ways of recovering arrears from future upside instruments. Deals are being reached, but there needs to be flexibility on both sides. So we're hearing from the market that if you approach with lease term extensions and removal of tenant breaks, so a give on the tenant side, you may well get a rent-free period or rent reduction over the longer term. There are also turnover rent plus a base or pure turnover, excuse me, I have a tickle in my throat, I'm sorry, or pure turnover with a longer term, with possible share in upside. So it is negotiation that is key. What is also clear from discussions with the market and lawyers and agents is that any deals are confidential. Landlords do not want details of agreements in the market because, of course, that gives them an issue when they're coming to negotiate their next deal. We understand that there are opportunities for new leases, and some of these are being negotiated on pre-COVID market rents with side letters. So again, externally, a new lease term may look like a pre-COVID market rent, but there will be a side letter with concessions. There are restrictions, as we know, on the landlords from taking action. Our view is that those restrictions and many of the government measures are likely to be extended, but we've yet to have that confirmed. We do understand that some landlords are getting really frustrated with the current position and are looking to forfeit by looking for other breaches in the lease. So maybe that is something to take into consideration when you're looking at larger portfolios, is just the attitude of the landlords. And again, that comes back to, if you're engaging with your landlords, you are more likely to get a consensual deal. It's also worth noting here the impact of the recent decision in the business interruption case that was brought by the FCA, which means that many thousands of policyholders can now get their claims for coronavirus-related business interruption losses paid. And landlords may well look for a share in that payout as part of any lease negotiations. And lenders may also look for a share in that payout as well. So there will be a lot of negotiation going on with regards to who gets to use those funds. One thing we're pretty clear on is that businesses should be expecting an increase in premiums for that type of cover moving forward. I'm conscious we're getting close to time, so let me just read you quickly. On the pre-COVID business model, I read an article last week in the Times from a professor at King's College London, and he said, it is clearly time to review what we sell and how we're selling. Moving blindly online and trying to serve and increase customers remotely isn't necessarily a panacea. No matter how your business is faring today, you need to take time to look in fresh directions for new products, to brand extensions and partnerships. He concluded by saying, no one can know what the new normal is. The trick is to be ready for what comes next. And we agree with this. We suggest that businesses should be reviewing their pre-COVID operation model and identifying where possible how to increase cash in the short term, but then moving and looking at profitability. Simply increasing revenue at any cost isn't going to work. Examples how this model may be reviewed is the retraining and upskilling of staff to provide a more flexible workforce, optimizing supply chains, entering into strategic partnerships, and as Sophie mentioned, embracing technology. Some of those, as Sophie said as well, will have a cost implication in the short term, but this should hopefully be recouped in the longer term. And what is clear is businesses in this sector, in the consumer market sector, cannot stand still. When we look at phased reopening, understanding which units to open and when will depend on the sector, the location. So if it's an office type location, as opposed to a local community, would you open whilst people are still working from home? And it will also be dependent on the government's attitude and whether the government brings in a furlough runoff scheme to assist with hospitality type businesses, and whether they extend any of the other measures which are currently available. We're going to turn to the next slide. I am going to get through these next two slides quickly, I promise you, so we can get to the questions. So we're just going to look at some issues facing retailers. Many of the retailers face the challenge of being overstocked. They'll be holding spring-summer 2020, autumn-winter 2020, unless they've had an online presence or have utilised marketplaces, we'll still have a lot of excess stock to sell off. And then they're faced with the conundrum as to what to buy now. And that will be very much, and how much, and that will very much depend on when the restrictions are lifted. And so they may be faced with, they have their old stock, autumn, winter, which they're going to be trying to sell in April, May, which if you're me, I'm not buying a winter coat in April or May. They then face the challenge of how to pay for new stock and the lead times for delivery. Stock finance may well be available and should be explored if it's not already utilised, but the stocking may be compounded by supply issues which Harry alluded to, which could either be Brexit or COVID. So whilst restrictions in the UK, COVID restrictions in the UK may be lifted, we may find that overseas suppliers are impacted and that will impact on our supply chain into the UK. We may find as I think Harry also mentioned, that we have another, a mini roaring 20s style boom, and retailers will find that, that the consumer is coming back. But we may find that the consumer habits have changed permanently, particularly given the awareness around sustainability and the ESG agenda. Apparel retailers in particular need to be assessing their product offering. And there may well be a shift away from the formal wear, to more leisure wear. So they need to look at their product offering. We think we will see more strategic partnerships, brand consolidation, and footprint reduction across this sector. And we expect to see further contraction in the apparel sector as a result of this. So those businesses that take the time to undertake an operational and P&L review, identifying areas of and the reasons for underperformance, will be better placed to develop a business plan which takes them through to the longer term. Moving to restaurant and bars, so the next slide. Unfortunately, there is a long list of restaurants and bars that will not be opening their doors following the lockdown. I don't know if anybody read the article in the London Evening Standard the other week. There was a whole list of, including Michelin star restaurants. So whilst retailers may well have been able to survive by moving online or hibernating completely, it does seem that the hospitality sector has been harder hit, particularly those that didn't offer or couldn't offer takeaway. And for some, reopening with continued social distancing restrictions, which we expect to go on for many months, may simply not be an option, as the business model just isn't viable. Those that do open will need to ensure the premises comply with health and safety. A closed restaurant will quickly deteriorate, requiring deep cleaning, which on a large estate may be quite costly. So they'll need funding. They'll need funding to purchase new stock. Old stock may well be out of date, definitely will be if it was perishable. And they may also face the issue of staff and not having any staff, because that many restaurants will have used university students or overseas staff, and many university students simply haven't gone back to university, and many overseas employees may well have gone back to their country of origin. In this hospitality sector, there have been calls for more support, particularly in the form of a Minister for Hospitality, which was debated in Parliament last week. There are also demands for more grants from government to assist with reopening. And we will have to watch this space really to see what the government does come forward with, because these businesses will need additional support in our view. Again, businesses reopening are going to have to work out which units to open. And again, as I mentioned with retail, that will really depend on location, their customer base, and their particular offering. So just in conclusion, it really is all up in the air. There will be a whole lot of outcomes. Management teams that think about it now and engage with their stakeholders during the lockdown and put together plans will be the ones that are more likely to be successful when they come out on the other side. Thank you for listening. I'll now hand back over to Stuart for the Q&A session.
Sarah, thank you, and thank you to all our wonderful speakers and for the very interesting and insightful content that you've delivered over. I have a number of questions that have come in, which I'd like to put to you in the remaining few minutes. And actually, Sarah, if I can ask you to come back on, I think it's timely just to ask the question to you about whether we think, as a result of you talking about the need for sort of consensual restructuring, do we think there's going to be a flood of CVAs? Is that what 2021 is going to look like in your view?
That's quite an interesting question. And when I looked at what happened in 2020, I would have said no, because whilst there were some high-profile CVAs, there were also far more pre-pack administrations. But I was debating this very topic yesterday with one of my colleagues, and the very fact that we do have strong management teams now, and that we do have businesses that were successful pre-COVID, may actually mean that actually the CVA may come into its own and may actually be the restructuring tool. You might need to put a restructuring plan alongside it to deal with the financial instruments and the secured loan lending. But actually, it may be that we will see more CBA. So I'm changing my position on that, Stuart. Last week I was definitely it's all going to be pre-packs, and this week I'm more, yeah, I think we might see some more CBAs.
Watch this space. Thank you, Sarah. Question, Sophie, for you coming in to the panel. What's the panel's view on likely consumer behaviour in the longer term? So, Sarah touched a bit on this. Will people fundamentally reassess what they need to buy, especially with a climate crisis in mind, or will pent-up demand cause people to splurge on frivolous luxuries in the new roaring 20s? Lovely question. Thank you, Caroline.
I wish I had a crystal ball for this, actually. I think it's a really, really difficult question to know. I mean, leaving aside climate change, we've already seen a huge shift in what people are buying. You know, as everybody knows, an obvious one from party wear to loungewear. And what extent will that continue? People have had a wardrobe full of their office clothing. Are they going to go out and buy more office clothing when they might want to wear what they've already got? So I think there is going to be that sort of shift in what people are buying and their views on what they need is certainly to some extent going to stick. I think there is pent-up demand, and we mustn't forget actually that there's been a whole sort of part of the population who have saved quite well in this pandemic because they haven't been out there spending on restaurants and socializing and holidays. And so, you know, when that pent-up demand comes, there are actually, especially my boys who all returned home and you know, it's mum that's been paying out. So there's all these savings also that part of the population have which can spend. I think turning to climate change, though, this is going to be right up on the agenda, and it's going to not only be driven by the consumer, but also by the investor community. And there is going to be a significant shift in due course on this.
Lovely, thank you, Sophie. Perhaps a question now for Harry, just in terms of what's happening from a transactions perspective, always of great interest to myself. You said that a lot of the leisure sector is clearly closed at this moment in time. What are you seeing from a transactions perspective in these consumer markets in the UK and perhaps wider?
Yeah, very interesting. So 2020 saw the most private equity money spent since 2007, which is quite incredible, really, given the year we all went through. So M&A activity has been incredibly buoyant. Less so in my sector, leisure sector, which has been a funny old time. Travel operators, outbound ones, have clearly had a very tough year. The staycation operators, so domestic businesses, traded very, very strongly. Obviously, restaurants, hospitality, we saw the end of June and July, lots of restructuring activity. So lots of pre-pack deals there. And elsewhere in leisure, so quick service restaurants, trading very, very strongly. So any brand with drive-through sites, for example, are trading up to double what they were in 2019. So it's a bit of a mixed picture, but the vaccine news was a big stimulus for M&A activity. Yeah. So what we're seeing now is people going, right, what the best businesses in sector, who can we back to benefit from some bolt-on activity over the next 18 months that might be priced a bit better as opportunities arise as we recover from the crisis. So we see lots of those type of platform investments for growth over the next 3 years.
Excellent. And does that talk then to, if you like, something of a boom followed by a recession? How do you see the shape of things, Harry?
Well, the data last year suggests that M&A activity was really, really strong. And obviously that's different by sector. About a third of deals last year were in technology, the tech sector. This year, I think we'll see more consumer leisure deals, certainly than there were last year. But
Good,
I don't think it'll be boom bust, Stuart. I think it will be a steady flow of activity for the next few years.
Okay, and just I think time for one more question before we hit our target and wrap up within the hour. Perhaps one for Sarah. Lots of predictions on when CVAs and insolvencies will start. September 20 being a case in point now with government funding ending. Do you think momentum will build from April or Q2 of this year, or what's the BDO view on when we think we'll see a material increase in insolvencies? Reflecting back, of course, that at the moment we're seeing levels of insolvencies down by 30 to 40% year on year.
Although CVLs strangely were up in December, which is a bit of a conundrum. I think you meant 2021, not 2020.
Sorry, I did.
That's all right. I was slightly confused. I think we will see it. I think stronger management teams will start planning now, and we may well see more management teams coming for advice now. But I think the uptick, and I hate giving predictions because they're always wrong. The uptick will be in the latter part of the summer, late summer, and possibly yet September 2021. But I think management teams, a well-prepared management team, will be looking at their options now.
Very good. We've hit our time for this morning. So again, a big thank you to all of our speakers and thank you to you all for attending this morning. It's lovely to have so many of you out there and for us to be able to still continue to participate and to engage with you during these difficult times. Stay safe and stay well, and we look forward to working with you all during 2021 to help you in your businesses. Many thanks.